Okay. So thank you, David. Can somebody confirm in the chat that they're able to see David's screen, the presentation? Perfect. Okay. So we can get started. And I don't know if David, you want to start with like introductions, or how do you want to?
Yeah, let's do that. You want to go first and introduce your group, or?
Of course. So, hi, my name is Daniela. I'm part of the team at Launch SA, and if this is your first interaction with us, we are a small business entrepreneurship center. We're based in San Antonio. We used to be located, well, we are located, but we're not there physically right now at the Central Library downtown, the big red building. So right now it's a small team, so we're working from home, but we're trying our best to still have resources and put out resources for small business owners to engage and feel supported through their journey. So we do help people that are starting out or people that already have an existing business. And we're able to do all this through the help of other small business owners like David Fleming, CPA, and also other partners and organizations in the city. So we're very grateful that we have great partners and a great community in San Antonio. And with any questions that you may have, it would be regarding starting or growing. We're here for you. So just make sure to contact us first. We might be able to save you some time doing it.
Okay, thank you very much. My name's David Flemings, and I have a small CPA firm here in San Antonio, and our primary focus is the small business community. We work a lot with startups, which a lot of CPA firms don't, just because it takes a little extra time, and startups have to hold their hand a little bit, but we enjoy doing that. One of the biggest concerns people have is what type entity should they be, and how, if I choose to be this, what's going to happen. So we have a presentation here that we've been given for a few years, and we go through the different business types, how they're taxed, and then there's some other tax issues you need to know about, like franchise tax, personal property tax, information reporting form, different things like that. We're going to try to cover them all today. I think we have plenty of time, so as we're going, if you have questions, I believe you through the chat, you can ask some questions, and then we'll try to answer those as we go.
And I can, if you don't mind, David, I can be the one that asks you or let you know that,
okay, perfect,
that there's a question. That way we're not interrupting. And you can also use the feature to raise your hand, and that way we will get to you.
Okay, what I'll do then, when I get to a point, I'll stop and say, is there any questions? And then, we'll just take it in sections. I think that might work well.
Great.
Okay. We have to do the obligatory disclaimer that, this is not really tax advice. This is general stuff. So good advice to one person, bad advice to somebody else. It's all based on your circumstances. So what we're going to talk about today is the different business organizations, like I mentioned earlier. We're going to spend about a minute or two on bookkeeping systems and accounting methods, which you need to know. Record keeping, how long should you keep your records? Do we burn them after we do the tax return, or do we, what do we do with them? Put them in the closet and keep them for 100 years? We talk about that. What do we need to keep? Information returns, which are your 1099s. Everybody loves 1099s. And then the franchise tax and the personal property tax. And keep in mind, the franchise tax is not if you own a McDonald's or a Blimpies or a Subway or something, not that type of franchise. It's just what the state of Texas calls its tax to allow you to do business in the state of Texas. And as we talk about the different entities, we'll tell you whether or not you have to worry about franchise tax with them. And then the personal property tax, which very few people have ever heard of. And generally we have about 95% of people go, what? When we get to that part. So hang on, it's going to be a lot of fun. Okay, different types of business organizations, and we've left nonprofits off of here because basically we're focusing today on Theoretically, businesses that are here for profit, we don't always make profits, but this is our goal. So there's something called sole proprietor, general partnerships, limited partnerships, C corps, S corps, and limited liability companies, or another term, LLCs. And we'll talk about how all those work. We're going to talk about each one specifically. Okay, a sole proprietor is the simplest thing that you can do to start. All you got to do is basically, you probably should walk out in the front porch and say, I'm in business. You walk back in, shut the door. You are a sole proprietor. That's all you really have to do. So it's a very loose construction. If you want to quit being a sole proprietor, you walk out the front door, you say, I'm done. I don't want to be a sole proprietor anymore. You go back in your house and you're not a sole proprietor anymore. So very, very easy to start, very, very easy to stop, very, very easy to get in trouble also. So let's talk a little bit about sole proprietorship. If you are a true sole proprietor, you do not have to worry about state franchise tax. Just take that one off your list. It's not something you have to worry about. You will need to worry about the local and county personal property tax that we talked about. You may or may not need to get a sales tax certificate. So you can be a sole proprietor, and if you're selling something that requires sales tax to be collected, you're going to have to register with the Texas State Comptroller for sales tax. Then you'll have to collect that and remit it. It's not like registering as an organization. You're registering purely for sales tax in that regards. The sole proprietor is taxed on your personal tax return. On your 1040, there is a Schedule C, like in CAT, which is basically titled Profit and Loss from Business. So it's a income statement only. It's not a balance sheet. All it does is here's my sales and here's my expenses. And it's got a bunch of categories on there. And then some blanks at the bottom where you can add more categories if your stuff doesn't fit in the ones that they have. All of this rolls forward to your front of your 1040. So if you file the Schedule C, and let's say it comes down to be $100 profit, then that $100 profit is pulled over to your 1040 on one of those schedules. I can't even keep up with the schedules, 2, 3, 4, one of those, but it's the schedule. It's from the Schedule C goes up there. It's added to your income. So if your spouse has a W-2 income of $1,000 and you made $100 as your sole proprietor, you've now got $1,100 that you're going to pay income tax on. And what is even more fun and more enjoyable is that you get to pay not only income tax, but you pay what's called a self-employment tax. Self-employment tax is basically Social Security and Medicare tax. So when you work for somebody else, you look at your W-2, you see on that W-2 that they've withheld Social Security tax, they've withheld Medicare tax from your paycheck. What you don't see is the company doubles that. So if the company takes $100 from your paycheck, company puts another $100 of their own money and they send $200 into the Social Security Administration. Well, as a sole proprietor, you don't have that. So you've got to send in the entire amount yourself, and that entire amount is 15.3% of your profit, not your gross income, but your profit. So what we were saying just a minute ago on that Schedule C, if you had $100 profit, then that $100 would be subject to the 15.3% self-employment tax. That then is calculated also on your Form 1040 on page 2. And there's a form Schedule SE for self-employment tax that you fill out to get the number that transferred to your 1040. So as a sole proprietor, everything's done on your personal tax return. There is no separate tax return that you have to worry about. And one thing, let me just throw it out there. If you are a sole proprietor, you are not an employee. So if you hire employees and you're running payroll for them through your sole proprietorship, you should not be on payroll. you are the owner, you are a sole proprietor, you're not an employee. So don't let yourself get in there. You'll end up paying some extra unemployment taxes and things by being an employee. It pretty much works out the same except for that, but according to the IRS, you are not an employee. So that's the easiest thing you can do. The downside of a sole proprietorship is that you have zero liability protection whatsoever. So let's say your sole proprietor is a food truck and you're dealing with hot grease, you're dealing with all kinds of stuff. Kids are outside playing or something, they run up, bump into your truck, spills grease on them, burns the kids. You are personally liable for everything that happens. Every single personal asset you have is subject to being sued and taken to pay for lawsuits. You typically, your only way out is buying a lot of good insurance or bankruptcy. And typically, filing bankruptcy is not something we aspire to do. We're not, everybody's lined up not to do that. So anyway, sole proprietor, very, very simple, start, stop, simple, but you're wide open from a liability standpoint. So be real careful. Some of the other business entity types are going to help you on the liability, and that's why you need to consider different opportunities here. The second type is called a general partnership. And, you know, as a sole proprietor, we walked out the front door and said, I'm in business. With a general partnership, you need at least two people to walk out the front door. So you could take your best friend since kindergarten. We've done everything together since kindergarten. You both walk out on the front porch. You say, we're in business. Go back in the house. You are now in business as a general partnership. Again, this one is not subject to the state franchise tax. Generally, it's not. There are rare exceptions where it is, but generally it is not. Still going to have to worry about personal property tax. And like I said, we're going to talk about all these different taxes and how they work. May or may not be subject to sales tax, depending on what you're doing. This general partnership does not file on your personal return. It files a separate tax return, Form 1065. However, the answer or the result of that Form 1065 comes back to your personal tax return. So you as a partner end up paying the tax for the partnership. And what happens is the partnership files a 1065 form. Let's say it comes up with $100 profit. There's two partners, you and your buddy since kindergarten, 50-50 partners. $50 of that profit would assign to each of you. Then each of you would pay tax on that $50 as it's reported on your personal return. So what we see a lot is people who are first year in business, they run off and file their personal tax return because they're looking for, refund. They obviously want to get their refund pretty quick. What they're not paying attention to is that the partnership or the business typically has to go first, and the results of that are going to be added or subtracted from your personal return on the 1040. The general partnership is subject also to the 15.3% employment tax. Typically, it is going to be, so you're not going to get out of that. You ever seen those big red circles with a line through them that says, don't do this? No smoking, no guns, no whatever, no bicycles on or skateboards on the sidewalk. We kind of put a red circle around a general partnership and draw a line through it. And obviously there are times when it does make sense, but in general, we don't typically recommend that somebody be a general partnership, primarily because of the liability issues. Like we were talking about the sole proprietor and the food truck and the grease spilling and everything. That was one person. Now we've got two people, or a general partnership could have 100 partners. Every single partner is liable for everything that happens in that partnership. So if it's you and your buddy from kindergarten, your buddy from kindergarten has a drinking problem per se, or he likes to drive when shouldn't be driving, he has wrecks, he has accident, guess who also is on the hook potentially would be you as a general partner. So again, we don't think this is a good idea. Always suggest you speak with an attorney to determine your legal liability in certain situations. They also help in determining what type of entity you should be. So anyway, draw a big red circle around that. Typically, you're not going to do that. There are good occasions, though. And here's something that's similar, but now you're starting to get somewhere as far as liability protection and different things here. This is called a limited partnership. General partnership is everybody just walk out on the front porch. You said we're in business, you go back in. Limited partnership's very formal. You have to file with the Texas Secretary of State as an entity. You have to file that says we are going to be a limited partnership. You get approved by the Texas Secretary of State, and then you can go forward. The limited partnership, the name is going to tell you something. It's got now a combination of general partners, which are liable for everything, and basically they're making the decisions and operating the place. And you have limited partners, and the limited partners are purely investors. Typically, in a limited partnership, you'll see them a lot in real estate and construction of buildings and various things, or house builders. A lot of times are limited partnerships. Let's say I want to participate in one as a limited partner. I'm going to find them and say, here's $1,000. I want to be an investor. And they'll go, great. Here's your, they'll give me a partnership certificate or something showing that I own part of it, and I'm out of it. At that point, I make no decisions. I have nothing. If it goes bad, sorry, you lose your money. If it goes good, I make money. That's the definition of a limited partner, somebody who does not actively participate. So as a limited partner, my risk in that situation is $1,000. Worst that can happen to me is I lose $1,000. They can't come after me personally or anything like that. Now the state requires that there be at least one general partner, and they have to own at least 1%. So you could have a general partner that owns 1%, limited partners that own 99%, and that all works out fine. So because of liability protection, when you register with the Texas Secretary of State, all of a sudden you are now subject to the Texas state franchise tax. So you'll notice it, number one up there, we said you are now subject to the franchise tax. You are going to be subject to the personal property tax, maybe not on the sales tax, just like the others. This type entity will file a Form 1065, exactly the same forms as the general partnership. There's just a box that you check that says, if you're a general partnership, you check a box that says you're a general partnership. If you're a limited partnership, you check a box and said you're a limited partnership. Each partner is going to get part of the profit or loss allocated to you. Even if there's 1,000 partners, each of us as a partner is going to get a piece of that profit or loss allocated to us. It comes on a Schedule K1 that comes in the mail or get emailed to you from the partnership. So if you are a general partner in this limited partnership, then generally you're going to have to worry about the self-employment tax. If you're a limited partner, like in my situation where I'm just putting in $1,000, any gain or loss that I receive from that is not going to be subject to the self-employment tax. So you'll notice as we get more of the liability protection, more formal, then things start to get a little bit serious here. Limited partnerships is generally, for the most part, is not something that the majority of new businesses want to be. If you have a bunch of investors, yeah, we need to look at doing this. If it's just you and your spouse or you and your best buddy from kindergarten, probably don't want to go to the formalities of this. There are other options that we're going to look at here in a minute. Okay. There's something called a C corporation, or sometimes it's just referred to as a corporation, but that opens it up for further interpretation. A C corporation is typically the big companies that you think about that are on the stock exchange, IBM, Dell Computers, General Motors. Those are C corporations, which basically mean you have shares of stock that you sell. C corporation can be just one person, could be thousands of or tens or hundreds of thousands of shareholders, just depending on how big you are. And you may say, well, I don't want to go to all that formality. There's a lot of reasons that you want to be potentially a C corporation, and you don't want to just discard that. A C corporation is the only entity we're going to talk about today that actually pays its own tax, income tax. So you remember we were talking about the partnerships passing through income to the partners, the sole proprietors passing through income or loss to the owner. A C corp does not do that pass through. It keeps the money. It pays the tax from its own checkbook, so to speak. So it's going to be, because it's a legal thing, you have to set it up with Secretary of State. It's going to be subject to the franchise tax, county personal property tax, maybe not sales tax. All of those are just specific to what you do. This one files a separate tax return for a Form 1120, and that is the corporate tax return. The entity pays its tax, like we said. However, this particular entity is subject to something called double taxation. And most people have heard the terminology, but they don't really know what that means. Let's say a C corporation makes $1,000 profit, but it turns around and gives that $1,000 to the shareholders via something called dividends. Well, the C corporation is going to pay tax on that $1,000 because dividends paid by a corporation are not tax deductible. So the corporation's paying tax on the $1,000. They're distributing all the money, the $1,000, to the shareholders as a dividend. The shareholders are then going to have to pay tax on that dividend. Therefore, you double taxation. That $1,000 is taxed at the corporate level, and it's also taxed at the individual level. There's way around that. So don't let that be a hang up. The biggest interest on these is the tax rate. Forever, the tax rate was like 34% on these types entities. It had it started off, went up to 15%, but it got up to 34% really, really quick. Believe it was 3 years ago when the tax law changed quite a bit. These corporations went from 34% tax rate, which was not very attractive, to a 21% tax rate, which all of a sudden became very, very interesting, especially if you, as an individual, your personal tax rate, let's say, is 30%, you could operate your business through a C Corp and be taxed at 21%. Obviously, you have to pay yourself salary and different things, but it makes it very, very attractive. The new administration has indicated their desire to raise the 21%. They think it's not high enough. So very likely the rate on this could go up to 28%. Don't know for what time frame. If they're going to make it retroactive back to the beginning of 2021, or if it would start, at a later date. We don't know that yet. But a C corporation, we probably see about a fourth of the time, a fourth of the small businesses we work with are probably a C corporation. And if you don't like that, let's try something called an S corporation. Most people have heard of this. It's another term is subchapter S corporation, or just an S corp. A lot of people have heard of it. Not a lot of people know how they work, but they are a pass-through entity. So we're done with corporations paying their own taxes. When I'm saying taxes, I mean income taxes. The S corp now flows its profit or loss down to the individual shareholders, and they actually are the ones that are going to pay pay the tax on that. The S Corp is subject to state franchise because you have to, well, let's take a step back. An S Corp is not an entity you create with the Secretary of State. You cannot go to the Secretary of State and says, I want to create an S Corp. An S Corp is nothing but a taxing election. So you have to go create something else first. You go to the Secretary of State and say, I want to create a C Corp. Then you can go to the IRS and says, okay, IRS, I've already got a C Corp. I want to be taxed as an S Corp. That doesn't change the fact that you're a C Corp with the state. And if you ever get sued or whatever liability wise you are and will always be a C Corp, you're just paying taxes under the S Corp taxation election. So it is formal. Again, it's a formal deal, therefore subject to the state franchise tax, property tax, sales tax, yes, all of those, all of the above. It files a separate tax return like most of these are, except for the sole proprietor. This one's filing an 1120S. So it's 1120 as a corporate return. You tag an S on the back, all of a sudden it's a subchapter S corporate return. It's not subject to the double taxation. So by electing the subchapter S, you can take that C Corp and make it where you don't have to worry about the double taxation. And there's some advantages for the self-employment. The income, the IRS is going to require you as an owner, if you work in an S Corp, it's because they require you to get a salary. So a while ago, here's where it gets confusing. When we were talking about sole proprietors, we said, nope, you're not an employee. You don't take a salary. What I didn't mention was when you're in a partnership, if you're a general partner and you do work, you're not an employee, you're not on payroll, you're just a partner. If you switch your company to an S Corp, then the IRS says, sorry, now you are a partner. You are an employee. So you got to watch the rules. They go by pretty fast. You kind of have to pick them out as they come. But there are some advantages to an S Corp related to the self-employment tax, and it's a little deeper than just the discussion of this. I think, in fact, we've got another presentation in a week or two specifically talking about S Corps and how they work and that type of stuff. So I might encourage you to take a peek. Go to our website at PlemonCPA.com. We've got a calendar with a lot of our workshops and presentations there. Find the one on S Corps if you're interested in this. We'll spend a whole hour just talking about the S Corp stuff. And then there's this wonderful, wonderful thing called a limited liability company or an LLC. And LLCs, they've been around a while, not as long as some of the other type entities. They've been around, I don't know, probably 30, 40 years or more. I'm not sure exactly. But they are by far the most popular way to create an entity at this point in time. They're easy to operate. Yes, you have to set them up with the Texas Secretary of State, but some of the rules you have to keep afterwards are a little better, a little easier to keep up with. So you go to Secretary of State, you create this, therefore it's going to be subject to the state franchise tax, personal property tax, sales tax, same thing. The taxation part of it is where it gets somewhat interesting. If you go to the IRS website and you look for tax forms for an LLC, there are none. They don't exist. You know, like a corporation's 1120, a personal's 1040. There is nothing for an LLC. So the way the IRS treats this is they have certain defaults, or you can choose how you want to be taxed, which makes this just even more and more fun. So if you're a single owner LLC, you create an LLC, and the primary reason you're going to want to create one is a liability protection. There are, a couple of tax things that are beneficial, but primarily you're looking at a liability protection type deal. You're going to create your LLC. If it's just you as a single owner, the IRS is going to call you what's called a disregarded entity. They are then going to tax you exactly like a sole proprietor. So if you're an LLC, single owner, and you don't tell the IRS any different, you're going to be taxed just like the sole proprietor. So flip the charts back to the sole proprietor chart, and that's how you're going to get taxed. Schedule C, Schedule SE for the self-employment tax, it's all going to roll back into your 1040. If you've got multiple owners, like you and your best buddy from kindergarten, you guys filed with the Secretary of State, you created a limited liability company or an LLC, and you don't tell the IRS anything different about how you want to be taxed, then the IRS is going to treat you as a partnership because it's two or more. So go back to the partnership rules, and those are the ones that you'll follow. You'll file a Form 1065, partners will get K-1s and all of that fun stuff. But again, the reason you want to do the LLC primarily is the liability protection. Like I said, there's some other tax benefits, but the main one is the liability side, I think. And if you don't like those options, if you don't want to be a sole proprietor, you don't want to be a partnership, then tell the IRS how you want to be taxed. So you've got certain time frames. You say, okay, I created an LLC and I want to be taxed as a C Corp. You can do that. Or I created an LLC and I want to be taxed as an S Corp. You can do that. You just have to file the forms with the IRS, tell them how you want to be taxed. And then they will allow you to be taxed that way. If after a period of time, you may come in and say, as a single owner LLC, you just want to let it go to a sole proprietor, and then 3 years later you go, you know what, I really want to be an S Corp. You can still change to be an S Corp at that time. You just can't jump back and forth. Once you make a selection like that, you have to leave it for, I believe it's 7 years before you can change back. But the LLC, depending on how you have it taxed, is going to be subject to the self-employment. If you tax it as an S Corp, C Corp, no, but as a partnership, sole proprietor, yes. And then you have the capability of having limited members in an LLC, which are not going to be subject to self-employment. So the number of moving parts increases as we continue to go through this presentation. But the vast majority of people we see right now are creating LLCs, and we give people a test. Go down your neighborhood, knock on your neighbors' doors and ask them if they're an LLC. And I bet you half of them have an LLC, but they don't know why, but they'll have one. It's just fun. We're weird, accountants are weird. But it'd be fun to see who they are and why they did that. Okay.
David, there's just a question about from Olivia saying, can you explain the personal property tax?
We're going to, it's a slide towards the end. I think it's the very last slide. So Olivia, if I don't cover it when we get there, raise your hand again and slap me a little bit. But are there any questions about the entity types and their taxation before we change subjects a little bit?
I think we're good. Yep.
Oh, we're good. All right. You need some way to keep a set of books. The more formal you get, sole proprietors, okay, we have some that keep books on spreadsheets or in just their checkbook. But the more formal you get, you're going to register with the Secretary of State. You better start keeping a lot better good books. That sounds really good. A lot better books. But an accounting method is a set of rules that you use to decide how to report your income and your expenses and your assets and your liabilities and all of that kind of stuff. And a lot of people don't even think about that until it's too late. Well, we always suggest get a little bit of help getting things set up, get yourself started off right. You may want to keep the books yourself. That's great. We encourage that. But get a little bit of help getting them set up so that you're not going down the wrong path somewhere. You'll need to look at your common accounting methods. There's a cash method and the accrual method. You can use accrual on your books, cash on your tax return, or vice versa. You just need to know the difference. And if you have QuickBooks or some kind of accounting software, you can switch back and forth just by clicking a button. But in a nutshell, the cash basis of accounting means it's not income until you receive it or it's available to you, and it's not an expense until you pay it. So if I do work for somebody in October and I send them an invoice in October, but they don't pay me till January under the cash method, it's not income to me until January. The accrual method is kind of the opposite. Accrual method means it's income when I earn it, and it's an expense when I incur the expense. So take the example of I created an invoice in October. My customer didn't pay it until January, but under the accrual method, that is income to me in October. I have to pay tax on it in the year that October falls. So think about it. I believe the limit, the IRS will allow you to be cash basis up until like a $25 million in gross sales. So once you hit that limit, they're going to force you to go to the accrual method. And if any of you guys listening get to $25 million in sales, come see me, because you're doing really well. Once you select, you're really supposed to get the IRS permission to change. Those things are not fun. Some people I've actually seen just switch and don't tell anybody. And after a couple of years, it's like, who cares? But a lot of really, really small businesses just starting out, cash and accrual, you're going to get pretty much the same answer. Now, some of the rules that the IRS gets from your accounting system, they say that your automated systems must produce sufficient legible records to determine your correct tax liability. What the heck is a sufficient legible records? Well, we're going to talk a little bit about that, but the IRS is very fuzzy. There are standard accounting practices, standard bookkeeping practices, and if you follow those, generally you're going to be okay. There's something called single entry bookkeeping and then double entry bookkeeping. Single entry is just your checkbook. I wrote a check to John for office supplies. I wrote a check to Susie for fuel or whatever it might be. That's just keeping up with the checkbook. Double entry is your debits and credit. You start getting, if any of you have nightmares from when you went to college or high school and you took that basic bookkeeping class, and they tried to convince you the debits and credits and where they all fit and which ones, you know, the Windows side is this one and the chalkboard side is this one. The QuickBooks, the Sage, the Wave, I never even heard of Kushu before, but there's a bunch of accounting systems out there. They're double entry. We highly recommend you use a double entry system. That's going to be able to track your balance sheet, your cash, different things like that. Do not recommend the single entry just because eventually you're going to have to do the double entry side. Okay, record keeping. And here goes our little very, very specific rules from the IRS. Records must be sufficient to substantiate items of income, deductions, and credits. They need to be good enough to enable you to prepare a complete and accurate tax return, to identify the source of the receipt, document the nature and business relationship of the deduction or the credit. So what the IRS does, let's say they pick your small business and they're going to audit you. First thing they're going to do is go through a pretty detailed questionnaire, spend a couple hours with you, asking you lots and lots of questions, having you explain stuff. How does it work? And one of those questions are, do you have an accounting system? And you're going, yeah, I've got Excel, or I've got QuickBooks or whatever. And they say, I'll give them to me. So if you've got QuickBooks, they want a backup copy. If you've got Excel, they want a copy of that file. They're going to compare those records to what's on your tax return. So let's say, and then they get what's called a general ledger. They're going to look at all of every single transaction you have, and they're going to pick some. Typically, they pick the bigger dollar amounts or things that look weird. You spent $50,000 on a vehicle. I want to see it. I want to see all the paperwork on that. So your records being sufficient to substantiate all that, you need to be able to pull all of the paperwork on that vehicle. Or Let's say you're a trucking company and you bought, $500,000 worth of fuel. They're going to say, show me the fuel receipts, or they may pick random samples, but you're going to have to go back to and show them all these details. So that's what they're talking about. You need to be able to go backwards, find the detail to support every number on your tax return. For travel, transportation, entertainment, gifts, etc., keep records and evidence corroborating your own statement. Let's say you go to Vegas for a so-called seminar. And that seminar is going to allow you to do a better job at what you do. One of the things the IRS likes is keep an agenda of the seminar that you went to. Keep little items that show that, yeah, I really went. Yes, I really participated, because I know y'all are probably shocked and you won't believe it, but people could actually sign up for a seminar in Vegas and go to Vegas and never go to the seminar. So you need to be able to prove that you were there. And then when you get into, I went to the seminar for 3 days and I stayed an extra week, you get into a lot of pro rata type stuff, because you cannot deduct when you're there staying the extra week. You can only deduct what's there related to the seminar. How long do you keep your records? It depends. It depends. Records must be kept as long as the contents are material to your tax situation. Generally, and this is again a very general rule, there's a 3-year statute of limitations from when you file your tax return. So if today you file your tax return for 2021, 3 years from today, theoretically, the IRS cannot audit that return anymore. 2 years and 364 days from today, yes, they can. 3 years from today, no, they can't, unless they suspect fraud or something highly unusual. But we typically recommend keep records at least 5 years, because you never know. If they were to come in and audit you the day before this statute expires, they're going to make you sign a piece of paper that extends the statute. Or what they'll say is, I will just disallow everything unless you agree to extend the statute. That's kind of how they operate. So you'll sign to extend the statute. You need to keep your papers a little longer than the 3 years. Some of the exceptions: employment tax records, 4 years. Records related to the basis of asset. Think about this. You buy a building and it's 1970. You bought a building that's still in your business, still being used in your business. You have to keep all of the records from that building from when you purchased the building until you sell it. And then the statute starts on about 3 years from that point, because you have to be able to prove what you paid for that building at the time you sell it. So don't just chunk everything out after 5 years. Think about what you're doing. And stuff on a computer, scanned documents are fine. You don't have to keep all the original paper, but you need to keep it scanned where you can get to it. All right, we see a lot of people get into trouble, I guess is a good word. It's not a good word, it's a bad word, but be very, very careful when you're bringing on additional help. A lot of our clients says, I'm just going to hire a contractor. And it's like, no, you can't. There are certain rules you have to follow. And we've come up with this is something we made up. It's called the trick. You have to look at the tools of the trade. A contractor will bring his own tools of the trade. An employee, you will provide them tools. Your air conditioner breaks, what do? You call the AC repair guys. They come out, they got a truck loaded with stuff, all kinds of tools. They're a contractor, hands down, no problem. If you got a guy on your staff, theoretically, who works, he fixes your building, he fixes stuff, and you pay him, he's really not a contractor, probably, if you're providing all the tools, if you're providing the direction. Risk, who takes the risk? An employee has no risk of loss, because you're paying an employee a salary, you're paying an employee by the hour. The employee cannot lose money by doing a project for you. A contractor can. Again, take the example of the air conditioner. Air conditioner broke. You're worried about what it's going to cost. You get the repair guy out and say, don't do anything until you tell me what it's going to cost to fix it. Air conditioner guy says, okay, it'll $5,000. We'll fix it. And you go, good. If it takes the air conditioner contractor $10,000, $20,000 to fix it, doesn't matter. He quoted you a firm quote of $5,000. So in that case, the contractor bears the risk of loss. So contractors provide their own tools. Contractors bear the risk of loss. Integration means how important is what this person doing is to your business. If somebody's just coming in, doing something, leaving, they're not very important to the business. We've had clients where the president of the business they claimed was a contractor. We're like, no, I don't think so. You're kind of important. And this was a worldwide company, and their U.S. president was a contractor. Finally, we got them, I think, to fix all that, but they were really hanging out there for a while. And the last one, and the one that's the most important, is control. How much control do you have over this individual? The air conditioner contractors, you're like, come out here and fix it. And they go, okay, we'll be there tomorrow. We're gonna fix it. You're not out there telling them how make that screw a little bit tighter, or no, you need to take this part off first. You let them do their job because they're smart, they're educated, they know what they're doing. An employee, you might be out there saying, hey, don't do that, don't do this. I need you to work at 8 o'clock. I need you to follow the company manual. I need you to log on and report your time this way, da, 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 da. That sounds like an employee. So tools, risk, integration, control. What you do is you put them in a big scale and you kind of weigh them out. And the risk of getting this wrong is pretty serious. Let's assume that you claim somebody is a contractor. That's your prerogative. You can claim they're a contractor. You file them, you give them the form 1099, everybody's happy. IRS comes and audits you and they go, no, not even beginning to go there. This person meets the requirements of an employee. And they got a lot of questions and a lot of forms they fill out, but they get to the bottom line and says, nope, this person's really an employee. All of a sudden, a bunch of rules kick in related to employee. There's an I-9 requirement. Did you get an I-9 filled out by this employee? You go, well, no, I thought he's a contractor. $11,000 fine. What about payroll taxes? Did you withhold payroll tax? No, because I thought they're an employer. I mean, a contractor. Sorry, you're going to have to pay all the payroll taxes you should have withheld and you didn't, and submit them to the IRS. Penalties and interest. There's things called trust fund penalties where they double all of this. Gets incredibly expensive. So if there's a moral to this short story, it's get help. If you're not sure 100% if somebody's a contractor or an employee, check with an attorney, check with your CPA, somebody, and work this out, because there are ways to have a situation. If you want a contractor, we can make it a contractor, but you have to lay all your bricks down ahead of time and build the right path. So I won't beat you guys up anymore about that, but just keep in mind it's very, very important and very, very expensive if you get it wrong. Information returns. Everybody loves the 1099 forms. Well, did you guys know there was a new form this year, 1099 NEC, for non-employee compensation? And that's for payments of $600 or more during the year to what we call a qualified vendor. This is business to business. So if you personally had an air conditioner guy come out, you don't care, that's personal. But if your business had an air conditioning company come out, then you might have to send them a 1099. There's also a 1099 miscellaneous, which has always been there, but they just pulled the non-employee contractors off of the miscellaneous, put it on the NEC. But the miscellaneous is for rent. Did you know when you're paying rent, if you're paying it to a qualified vendor, you need to send them a 1099. Your attorneys, prizes, healthcare, fishing boat proceeds. And some of those don't have limit. The $600 limit applies. Some of it don't. You have to look at the directions and sort it out. And I know I'm going really fast, and we're throwing a lot of forms at you, but this is partly why we ask that you work with somebody to help you work through some of these hoops so that you don't get in trouble. There's also a form called a W-9. So you say, I don't know if I need to send a 1099 NEC to anybody. Well, you have a form W-9 which helps you decide that. So let's say you bring in an accounting firm. You hire us to do something. You pay us, I don't know, let's make it good. Let's say you pay us $10,000. How do you know if you need to send us a 1099 or not? You paid us $600 or more, but are we a qualified vendor? You send us a blank form W-9, have us fill it out. On that form, we put who we are, what's the name of the company, what's our address, what's our employer ID number, how we're taxed and how we're created. Are we an LLC? Are we a sole proprietor? Are we a partnership? Or are we a C Corp, an S Corp? Any of those choices we have to fill out on the W-9, send back to you. You then look at the form and go, okay, I don't have to send them a 1099 because they're an S Corp. Keep that W-9 in your files. If you ever get audited, that's your proof why you didn't send a 1099 because you didn't need to. If I send it back to you, the W-9 with a category that says, you do need to send me a 1099, then you better do it or you will be penalized. And the penalties, the IRS has just started in the last year really enforcing the penalties and jacking them up. So you got to watch it. The penalties will start building pretty quick on that. 1099 NEC was due to your qualified vendors by January 31st. If not, they're late. If you didn't send them out, they're late. 1099 miscellaneous were due at later dates depending on what they were, but I believe that one is due in February, I believe. Don't hold me to that one. Anyway, that's how the information returns. You may think they're not important, but they are. Really pay attention to those. Okay, franchise tax. And again, like we said, this is not the McDonald's owning the franchise tax. This is just your privilege of doing business tax in the state of Texas, also called a margin tax. If you've registered for the Secretary of State, LLC, C Corp, limited partnership, anything that requires a registration through the Secretary of State and is a for-profit business, you're going to need to complete and file the franchise tax return each year. It is due on a normal year, and we hadn't had a normal year in a while, but in a normal year, it's due May the 15th. And the vast majority of people that file it do not owe any tax. Probably 90% of those who submit the forms don't even owe any tax, but you still have to file the forms. If you don't file the forms, the Secretary of State and the Controller will basically take down or take away your liability protection, and they will discombobulate your entity. I know that's a technical term, but it works. So how do you know if you owe tax? If your gross sales, gross revenues, which includes interest, dividends, sale of equipment, and sales of your inventory or whatever you're doing, all of those are added together. If they're less than 1.18 million or 1,180,000, if they're less than that, you're not going to owe any tax. So you just fill out what's called a no tax due form. And you also have to complete another form, which is who the owners are so they can keep up with the ownership. Pretty simple. If we do your tax return for your business, we do the franchise tax. Whether you owe or not, doesn't matter. We still do the franchise tax and take care of it for you. What you have to watch out is though this 1.18 million limit can change. It's changed several times since the margin tax calculations came into play. We used to have an old franchise tax, and about, I don't know, 10, 12 years ago, they switched to this one. But that 1.18 started out at 600,000. It's gone up, it's gone down. So as the state needs more money, they very likely could reduce that 1.18 million. So you have to kind of watch, see what it's doing. Like I said, normally it's due May the 15th. We just received guidance from the state controller that is now pushed out to, I believe, July the 15th. It's either June or July. Don't hold me on which month, but I think it might be July the 15th instead of the May 15th. You can see how the calculation works a little bit. If you're over the 1.18, then there's a couple of calculations how you get there. The tax rate is not that great if you're retail or wholesale, like a retail store or something like that. You got a 0.375%, and if you're not, it's 0.75. So the tax rate is not huge, but once you start running over that and you have, you know, $5, $10, $15 million worth of sales, franchise tax becomes an important number. So don't forget about that. If you register this to the Secretary of State, you're probably going to have to file this. You should receive a letter from the controller probably in February. So you should have already gotten it if you qualify for this, saying don't forget franchise tax is due such and such a date. Okay. Now we're going to talk about the personal property tax. And Olivia, if I don't answer your questions here, let me know. But if you own a home, you're familiar with this process. So as a homeowner, you get, every year you get something in the mail that says, okay, we're going to appraise your house at X, whatever that number is, always higher than the year before. We're going to appraise your house at X, therefore your property tax on the house would be Y. You've got an hour and a half to come protest this or whatever the time limit is. Otherwise, you're going to pay this tax. Okay, that's the real property tax, and that's how it works if you're a homeowner, if you own a building, any kind of real property. Personal property tax then is stuff that is not real property. So in your business, you have inventory, you have vehicles, you have computers, you have warehouse stuff. All of that is considered personal property. So the way this process works is we kind of have to rat on ourselves. There is a property tax rendition form that is put out by the Bexar County Appraisal District. And for those of us who are already in the system, they mail it out. It's like every year this thing just shows up and says, fill it out. If you're a new business, they may not know you exist yet, and they may not send you the form. So you want to go to the Bexar County Appraisal District's website, look at the personal property tax rendition form, and fill that out. If you're really, really small and you don't really have a lot of assets, let's say you're working out of your bedroom in your home, which a lot of us do these days, you probably won't owe anything on the personal property tax. Just to be safe, you might want to fill out the form and there's a box to check that says, you know, my business personal property tax. Again, this is business only. So even if it's in your bedroom, it only counts your business assets. 20K or less, check a box, send it back. And I believe that they don't even tax you on that, but it's for people that have more assets than that. They want to know what's the property owner's name and address. The property owner is going to be your business. Even a sole proprietor, remember, can have this requirement. Description of the property. Is it automobile, inventory, computer equipment, machinery and equipment? Where is the property? What physical location? You could have a business in San Antonio and Bexar County, but you could have your business in Guadalupe County and all your assets are there. So you got to put the physical location, and you can see what we got there for the inventory. Just can't talk. A description of each type of the inventory and an estimate of what it's worth, basically. Good faith estimate of the market value of all of your stuff. So if and what they're going to do is on the form, you say, I bought in 2020, I bought $50,000 worth of computers. As long as you don't sell those computers, next year they're going to tax you on a lower number. The first year, your tax will be based on 50,000 value. Second year, they're going to lower it. The third year, they're going to lower it, et cetera, basically to account for the fact that these assets are wearing out. If you decide you want to protest this, what you can do is you fill out the rendition, you send it to them. They send you a notice, May time frame. This says, okay, we assessed your property at X, and you've got, if you want to protest it, come on down. You call them, you make an appointment. If you go protest it, you better take your federal tax return asset schedule, because they're going to compare what you tell the IRS are your assets to what you tell them are the assets. And a lot of times people, believe it or not, might not have the exact same numbers. They either have to reconcile them as why this wasn't on the IRS schedule, or what's on the IRS schedule didn't show up on the Bexar County. You got a little dancing to do if you're not real good at that. But it's really not that big of a deal. Once you get into the swing of things, like I said, 20,000 or less, you're probably not going to worry about it that much. At our office, I think we pay $400 a year personal property tax, something like that. So it's not huge for the vast majority. If you're, we have trucking companies that we work with that pay $40,000, $50,000, $60,000 or more in personal property tax. Obviously, they're very asset heavy. Industries like that are going to have a lot more that they have to worry about. So that's the personal property tax. Hopefully, Olivia, I answered your question. If not, raise your hand in the chat and we'll try to get to it. And then I got time for some questions. If you want to reach us, if you want a copy of the charts, go email us at admin@PlymouthCPA.com, or our website is www.PlymouthCPA.com. Go on there and look for the education things that we're doing. And then we do some podcasts we call the Hustle, Juggle, and Struggle of Small Business. This is my advertisement, Jim. We have clients come on and talk about how some of the business issues they had. They started out great and this happened. Here's how we came through it. And they're very encouraging to see that people have really worked through issues. It's interesting to see the different things people come up with. A lot of them come up with the same things you do, but check out our podcast. We've got a bunch of them out there and we're constantly adding more. So given that, I will open it up for questions. I'm not even sure when we're supposed to get done. I hope I didn't run over.
No, we're just, well, it was scheduled for an hour, so we're good. If somebody has questions and if you're open to staying to answer those questions, feel free. You can drop your question in the chat, or you can unmute yourself and ask it straight to David.
We answered all the questions beforehand.
Yeah, nobody has questions.
Well, thank you guys for participating. I really appreciate y'all being there, and I hope it was worth spending an hour, a little over an hour of your time this morning. I'd love to hear from you if you come. But I invite people to the office to have coffee. We're not but we're not there like we used to be. We're kind of working out of home for the most part. But anyway, appreciate it. Let us know if you need something. Love to hear from you. And thanks for participating.
Thank you so much, David. Thank you, everyone, for being here. The recording, I'm going to stop it. But thank you so much for being here. And this is going to be stored on our YouTube channel. That way, if you want to revisit some of this information, you can do so. Also, you can reach out again to David and his team if you have any more questions or would like to get more insights. Like he said, they do these types of presentations, not just for us, but in the community. So if you want to catch something else with them or more detailed information, you can do so by going to their website. So thank you so much, and have a great rest of your day, everyone. Thank you, David. Thank you, Rita and Talia.
Thank you. We appreciate it.